Every economic entity must present its comparative statement to all its stakeholders. A comparative statement is a document used to compare a particular financial statement with prior period statements. Previous financials are presented alongside the latest figures in side-by-side columns, enabling investors to identify trends, track a company's progress, and compare it with industry rivals. How comparative statements work. Analysts, investors, and business managers use a company's income statement, balance sheet, and cash flow statement for comparative purposes. They want to see how much is spent chasing revenues from one period to the next, and how items on the balance sheet and the movements of cash vary over time. Comparative statement example. Assume, for example, that a manufacturer's cost of goods sold (COGS) increases from 30% of sales to 45% of sales over 3 years. Management can use that data to make changes such as finding more competitive pricing for materials or training employees to lower labor costs. On the other hand, an analyst may see the cost of sales trend and conclude that the higher costs made the company less attractive to investors. Comparative statement limitations. Comparative statements are less reliable when a company undergoes huge changes, a big acquisition, and move into new end markets can transform businesses, making them different entities from previous reporting periods. For example, if Company A acquires Company B, it may report a sudden sharp jump in sales to account for all the extra revenues that Company B generates. At the same time, profit margins might tighten at an alarming rate because Company B has a lesser lean manufacturing process and spending more money to produce the goods it sells. Steps in preparing a comparative income statement. Number 1. Specify absolute figures of all the items related to the accounting period under consideration. Number 2. Determine the absolute change that has occurred in the items of the income statement. It can be achieved by finding the difference between previous year values with the current year values. Number 3. Calculate the percentage change in the items present in the current statement with respect to the previous year's statements. So, as you can see, every economic entity must present its financial information to all of its stakeholders. The information provided in the financials must be accurate and present a true picture of the entity. In the next lecture, we will study ratio analysis of accounting. Thank you.